one of the things we do here at One Rental at a Time is we reach out to experts in the field who are doing the work. And in this case, we have the one and only Jonathan from Convoy Home Loans. We're going to talk about applications being up 25% or more month on month, which is wild. I guess rates matter. We're also going to talk about appraisals coming in low. Jonathan, thank you for being here. Why don't we break down appraisals coming in low? Because I don't think a lot of people understand that an appraiser can blow up a deal really quick.
Yeah, I mean, obviously, a lot of clients are always asking, hey, I want the terms, and I want to close with the best terms. But I'm like, hey, especially when it
Mhm.
comes to DSCR or bridge, I'm like, hey, all of this is great, right? Whatever anyone's telling you is great on the front end because they want to get you in the door. But if they're
Right.
not being honest about how important the appraisal is in the process, then you're shooting yourself in the foot, right? Because right now, and this isn't just like California or Florida, this is like across the board. I'm seeing a lot of appraisals come back, especially on people that thought a house was going to be worth a certain amount when they're doing or exiting a bridge, right? Or trying to sell the property. It's coming back like 50, 100, 200, $300,000 lower than what they expected. Um,
So let's do me a favor. Let's paint a picture of how this might happen. Because again, what you and
yeah,
I understand exactly what happens. So you're a fix and flipper somewhere in the country. You find an asset that you're buying 70%, you know, uh, below or whatever, 30% below. You do your fix up costs. You think you're gonna, you're buying it for 700, you're gonna sell it for 1 million. Just making it up. You get the bridge debt. Bridge debt's probably got 6 or 12 months on it. You're looking to exit. So you list it for $1 million. And then, for whatever reason, goes in contract, doesn't, whatever, you got to lower prices. But an appraiser comes in at some point near the end of that bridge and says, you know what, this is not worth 1 million, it's worth 800. Now you have a problem, right? If you're an escrow and you could sell, you could still close, pay back the bridge, but you're going to likely lose money on the fix up. But if you don't have a contract and you're just languishing on the market and you do an appraiser at 800 because you're looking to get out of the bridge into permanent financing, you're screwed. You better have a big checkbook to write that check so you can keep that property, right?
yeah, absolutely. And obviously, even if you try to refinance, right, and you get that appraisal, if it comes in that low, then you're in a situation where you're stuck, right? You can't take a loan for less than what you owe, but at the same time, you put all this money into it expecting to get something back, and now you're, like you said, you're having to bring money in. So I'm seeing a lot of people pivot and cut prices aggressively to try to sell the property, right, to their base margin or even below their margin. And like, for example, I had a client that was one of like 50 other properties in an area within a certain vicinity that were all
Mhm.
basically the same fix and flip looking type homes. Um, and they were just all sitting stagnant, nothing selling, nothing moving. Um, Nobody wanted to buy them, even if they were dropping values, right? Nobody wanted to touch any of them, right? And
Mm.
I think we're kind of entering into that market where, yes, the rates are lower and transactions are up, like you said, but they're up for houses and properties that people want to buy, right? And
Right.
there's a particular, I think, language to it in terms of like what aesthetic, what type of property people would want to live in, right? Those are the things that people are willing to bid over for right now. If you're trying to buy something as an investment property and you're seeing all these flips hit the market, you're as an investor, you're not buying these flips, right? You're buying to flip, if any.
At least not yet.
Yeah, exactly. So it's kind of one of those situations where it might be a good area or a decent area, but if the saturation of inventory, which is crazy to think of because we were talking like beginning of last year and end of last year talking about how there was no inventory, and now there's inventory in some pockets of the market across the country sitting, right? A
Yeah.
lot of inventory sitting. And that's kind of the case of what we were talking about, the failed bridges where they didn't do enough market research and do any of that. Like they just kind of follow the herd, right? It's kind
Yeah.
of like what happened is the herd mentality kind of overtook
Yeah.
situation. And so now they're in a situation where they can't sell the property, they can't refi because the appraisal comes in low. Like there's no like option really for them, and they're stuck at that point. So I'm seeing
Well,
a lot of
let's just play it out because there are options. None of them are good.
Mhm.
They could lose the property, right? Because again, that there's a loan on that property that says if you don't pay, we take it back. So there's probably some foreclosures or jingle mail or short sales in that mix somewhere. Um, some of them could try to pull equity or cash from other locations and just turn it into a long-term rental and kind of try to buy time, which again is not a great answer, but it is an answer. Um, you could cut prices, lose repair money. You could cut prices and lose purchase. I mean, there are some people are going to take some pretty big haircuts. I mean, I think I told you probably years ago, but back in '06 or '07, there was a guy flipping $1 million properties in the Bay Area who was printing money for 5 years. But there was this one house he had the opportunity to sell. He would have had to take a 50K loss, and his ego didn't let him do that.
Uh,
And not only did he lose that, but he lost his empire because
yeah.
that started a cascading of things. So there could be a reckoning, right? If you're one of those 50 properties in that area and they all look the same, it's a race to the bottom.
Yeah. And this is kind of like it kind of makes me upset on the lending side because I'm like, why are people writing loans, right, to these people that may not know better, right? A lot of these people that are flipping in these areas, they're not flipping because they have multiples of experience to go in that area. And the herd, a lot of the flippers that are experienced are not buying in the herds, right? They're buying
No,
where people
exactly.
no one's buying. So like I am a little upset when I see that because I'm like, I wish I could help you. And obviously the borrower is like, you have to help me. You have to help me. And I'm like, there's really nothing I can do. The appraisal came in low, right?
Yeah.
And the problem is that in these markets, like a lot of people, like you can always get a loan, right? Someone is going to issue you a loan, but is it going to be the loan that fits your scenario and helps you out? Or is it just going to give you what you want or what you think you want? And then you're going to pay the cost of it later. So what I've been talking to a lot of clients about now when they're investing in properties is price versus cost, which is kind of a big thing, right? Price, like what's the price right now? Is it you have to put a little more down, right, up front to protect your margin, protect your leverage? Or are you going to pay the price or not pay the price right now, which is I'm going to max out the leverage to as high as possible, 100% loan to cost or 95% loan
Mm,
to cost, where you have no margin, right?
yeah.
And then I'm going to pay the cost of it later, which is the long term, which is I can't go to sell the property, right? And I'm like encouraging clients, like if you're going to take bridge debt, even if it's not from us, like make sure it's 12 months at least, 1 year at least.
Yes. At
Like
least.
don't take anything less than a year unless it's a property that is like fully done. It's like
Right.
it's gonna hit the market tomorrow, and within the next 3 months it'll sell.
Yeah.
Until that point, take 12 months at least, because if you don't, you're shooting yourself in the foot. And make sure that even if it's a little more down payment up front, like just do it, right? Maybe not go to 90%,
Yeah,
95%
please.
loan to cost. Maybe go to 85 or 80, right? That difference is not going to kill you, but just keep it mentality in the mind of like it's a long-term game in whatever time period, that 12-month period. It's not a short-term game where
Yeah.
yeah, you're putting 5% extra down, but then now you're in a dire situation because of the extra 5%. That's not what
Yeah.
happens, right? But you're saving yourself from the future, especially if you want a DSCR, because rates are great. So might as well DSCR then after 3 months or 6 months if it doesn't sell.
Yeah, couldn't agree more. Well, let's talk about DSCR versus conventional. Last week we broke the internet when you said you had DSCR loans in the mid to high fives. I got, I don't know, a dozen to 20 comments on that. So hopefully you got lots of phone calls from our audience. But why don't we just talk about why would you do DSCR versus conventional? I think a lot of people are like, is DSCR riskier? Is DSCR harder? Are DSCR loans the thing that blew up last time?
Yeah.
Why don't you just define kind of the delta between the two, and then are rates still sub six?
Yeah, so obviously the biggest difference between DSCR and conventional is
Huh.
DSCR is investor focused. What I mean by that is a lot of investors are always doing write-offs. A lot of investors are always taking whatever deduction they can on their taxes. This doesn't involve their tax returns.
Correct.
So DSCR doesn't involve tax returns, doesn't involve bank statement income, none of that. It's just the property itself. So the easiest way to think about it is it's basically a commercial type loan, because that's how commercial loans are underwritten, not on the person, but on the asset. And conventional is what you know and love, blood drawn, doing everything, right? So conventional versus DSR, that's the biggest difference. Another big difference is on a conventional loan, you can't close in the LLC, right? You might be able to close in your name and then deed out to the LLC, but that may cause issues in the future. No one has the crystal ball, but it can cause title issues. It can cause, legal issues. It can cause like your note even potentially being called, right? That's a real scenario. DSCR, on the other hand, is written into the LLC and kept in the LLC. You're signing the note as a member of the LLC. So that's the biggest difference in between the two. Why someone would go one or the other is right now, if you're trying to buy a property, let's say this is the best example, on a 2 to 4 unit, right? We kind of talked about this a little while back, but 2 to 4 unit conventional investment, you have to put 25% down, right? Versus 2 to 4 unit on DSCR, for example, you can probably get away with 20% as long as it cash flows, right? So if it cash flows and you're buying in a market that's cash flow specific, then why not save the 5% and go DSCR versus conventional? Because that extra 5% in LTV is not necessarily going to give you the return on the money that you're putting in. So you can go 5% here less at 20% down on a DSCR loan instead of a 25%, and then use that extra 5% to either fix up the property, do whatever, or put it into a 15% down plus 5 on a different property, right? So, and the best part about it is, in this example, conventional 20% can't do it, right? So that's an X right there. DSCR at 20%, 2 to 4 unit, you're right now with our fund that we work with, you're probably looking at a low 6 rate, right? That's starting. And then you can
Yeah,
buy that into the 5s. And if you want to set it and forget it, because people are so obsessed with the fact that if I buy something or do something right now, I can refi in a year. But I
yeah,
always try to remind them, like, if you're putting the minimum amount down, you're not going to have enough equity in a year to do the refinance.
exactly.
So you might as well set yourself up for the future. And again, it's price versus cost. This is the biggest conversation that I'm having with clients these days. It's like, yes, someone else is telling you can do it with less down, and you're telling me that you can refi later. But it's so easy for a loan officer to tell you, yeah, just do it, put the minimum down, refi later. But it's like they don't tell you you can't refi later if you don't have the equity, right? You might
Hmm.
have to bring money in. So if you want to set yourself up for the future, just, if even if it's a buy down, I think it was like it was 6.25 starting, and you do like 1.5 or 2 points, get it to like 5.7 or 5.6,
Oof.
and then just, keep that, pay it down for 10 years, and then refi the equity after that, right? So it really depends on what market you're in, but that's the biggest difference in between the two, just in a nutshell.
Yeah.
But DSCR just has more flexibility, ability to purchase power, all that.
What I would tell folks that kind of question DSCR, that don't understand it, that maybe have PTSD from the Great Recession and all the loans blowing up. This is not, Nina loans, right? No income, no assets. This is not neg am loans where you're adding interest to the back. These are 30-year fixed rate products on the asset, bought and sold on Wall Street. And it's just another form of 30-year money outside of, conventional. It's not, it's nothing like the Nina loans and the neg am loans of '06. Is that fair?
Yeah, absolutely. Because here's the biggest thing too. Obviously, we need an appraisal, right? And
Mhm.
also, we're not lending at 100 something%, right? And you need reserves, right? Like you have to have liquidity. I have a lot of clients calling in like, I'm purchasing using just the asset. Why do you need my credit and why do you need reserves? I'm like, I need credit because I need to make sure you can pay back the loan. You have a history of paying stuff back, right? Which is reflected in your credit score. Or two, I need reserves to show that if your tenant leaves or something happens on this property, I need to make sure that you can cover the payments, right? And I think it's dangerous when there is zero reserves needed and
Yes.
LTVs at like 100%. And
Dude, an LTV over 95% is crazy because you're going to
it's
have minimum 6% of selling costs. I mean, come on.
yeah, yeah, and market swing, right? I mean, it's if we go through an economic downturn, which who knows? But if we go through an economic downturn and real estate happens to get hit, which isn't expected, but it happens to get hit, then what one night could be 5%.
Yeah, could be.
So
Yeah,
you're literally underwater after a day. Yeah.
absolutely right. Yeah. So let's talk about it kind of how we opened. Activity has gone up 25% month on month. I'm guessing, again, this is activity, not yet deals, right? This is applications, not closings. Let's be clear. But I'm going to guess rates matter. Rates matter. Rates are lower. I saw somewhere that the average conventional was 6.11, which is the lowest in the last 18 months. You have already talked about DSCR loans in the mid fives with a point or two. This is also purchase and refi, correct?
Yeah, absolutely. And purchase and refi, we're doing a lot of cash outs now where it makes more sense. Last week we talked about the blended rate, right?
Yeah.
Uh, Now we're talking more about the blended rate of like, hey, if you take a second at like 10% or 9% or 11% versus, and your first is like a 5%, right? It's probably
Mhm.
going to make more sense to refi into something in the 5.5, 6.5
Yeah.
range, right? On to pull the cash out if you're going to use it anyways, right? So
Yeah.
that's
This is going to get wild, man. If we get cash out refi rates around 5.5, there's going to be billions and billions of dollars taken out via, cash out refis, in
yeah.
my opinion.
Which DSCR we can already get to. And what was crazy was,
Oh,
yeah, DSCR, I mean, we can get to it. If you like, people are like, I get a lot of people that call in after watching the video and be like, you didn't talk about the cost of doing the 5.5. I said, yes, I do. I do every time. I don't
every
hide
time.
it. There's a cost to it.
Points. Yep.
It's for, yeah, you pay 2 points, 1.5 points, 3 points, whatever it ends up being for your scenario. But you're looking at it not, again, this is price versus cost, right? Price right now for saving in the long term, because you're essentially, the mental shift has to be, I am paying it right now so that I don't have to worry about it in the future, refi, meaning you're not having to pay closing costs again next time you refi, which
Yeah.
saves you actually more, right? From a mathematical standpoint, just paying the points now actually saves you more than doing a refi later, just because of the cost of doing it. So save you money now. You pay a little more right now. It sucks, but you're going to forget about it after you close, right?
Hmm.
And you're just going to enjoy the cash flow as it goes. Your rents are going to keep going up and you have it a long-term basis and you're good to go there, right? So, and
Yeah.
then conventional was crazy. Uh, I, I was blown yesterday because I was pricing out multifamily 4 unit in LA for an agent. And I did it with as aggressively priced as possible because I needed to get super aggressive on the deal. I was pricing 75%. It was a smaller 4 unit, so it was like 1.1 million loan amount,
Hmm. Okay.
but it was a 599 as like the starting rate as an investment property
Wow.
on the conventional side. Obviously that's with, origination, whatever, but that's 599 to start without adjusting, and then buying it down to 5.6, right? 25% down conventional, on a 4 unit. That's not the same on a 1 unit again, but
Correct.
if you're
Yeah.
talking about a 4 unit in LA, because the high balance limit in LA for 4 units is like 2 mil. This is
Mm.
half this is half that, right? So it's conforming.
Yep.
But yeah, I mean, it was kind of wild to me to see that
Ooh.
five handle
We're going to get
number.
the lending market is coming out of a depression.
Yeah.
You all went into a depression 2 years ago when rates shot up to 8%. I called the refi boom about 90 days ago. We keep having rates in the low sixes, high fives. The refi boom, that's it. Mortgage industry's out of the depression. I'm calling it right now. You're not going to shoot to the moon, but you're going to be out of depression level activity, which means you're probably busier today than you were 4 months ago, I'm guessing.
Yeah, I mean, I am. It's we were just talking about it before camera, but it's been a wild ride.
Yeah.
Yeah.
It's going to get fun. It's going to get fun in the mortgage. I don't know what this means for real estate agents because, again, you're not part of the refi process. And I do think refis spike first. But rates go low enough, you're going to see a lot more purchase activity as well. Jonathan, somebody wanted to reach out, work with Convoy Home Loans, talk DSCR, talk conventional, talk bridge. How do they do that?
Go to convoyhomeloans.com and let us know you came from more at. And one last point for real estate agents, because you brought them up. right? Reach out to the people that are doing a lot of activity in your market, right? And that could be us, that could be someone else in terms of like mortgage people, because they have a list of clients right now that they're working on cash out refis for, that the clients are actually looking to buy and deploy with that. They're not just looking to pull out the cash to just sit on it. They're looking to pull out the cash to deploy it into real estate. So this is a great opportunity for real estate agents to reach out to those specific, mortgage brokers or whoever in the area. And again, it could be us. It doesn't have to be us, right? But if you reach out to anybody, find out who they're doing cash out refis for, in what market, and then see if you can get an introduction and then get a good relationship going so that you can find good assets to deploy the capital. Yeah.
There you go. Jonathan, you're amazing. You got to tell me you came from Oret. That way you get Jonathan and or his partner, Dustin. If you just reach out and don't say one rental at a time, you're going to get somebody in a queue, and nobody likes to be in a queue. Later, guys.
Thank you.
Thank